And SPACs are companies that are basically given a blank check to go buy something, right? And the level of rigor and regulation that's in what they're buying has been a little bit, as Stephen Hawking once said, it's loosey goosey. So, but
Stephen Hawking didn't say that.
This podcast contains the arguably witty banter of two friends, Skippy and Douglas, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Morning, good sir.
What's happening? Let's go. You gonna yell at me yet?
Oh wow! I mean, this is like no pleasantries.
No, it's on. I know you're fired up.
Yeah. I mean, I read your book. I read your favorite book that you've been touting.
First of all, don't talk trash about my boy Tobias. But second of all, I didn't say it's my favorite book. It's quality, simple, easy read, with some value investing in Buffett. It's not my favorite.
It's a couple
book.
of those things, yeah.
But go. And for the listeners, we're talking about the acquires multiple. This is a continuation of a conversation we had in episode 15.
Yeah. So Skippy came with he was dropping knowledge, right? And was talking about this acquires multiple book, how it was going to change the face of investing forever. How it basically should change my mindset on all of how business should be run. So he was saying all this stuff, and I was like, oh wow.
Do we have a fact checker on this show? None of that's true. It's a quality book that reinforces that value outperforms.
Okay. So anyway, so he said what I said. I'm not sure about what he just said. And so I basically said, look, I'm going to go read the book because this sounds amazing. I'm going to go read the book and then let's talk about it. So I read it this past week. Before we get into the hot and heated section of this, do you want to give an overview of what the acquirers multiple is and what it means and why it overperforms?
So basic overview of value investing starts in the US and a lot of people say in the world with the guy named Benjamin Graham, right? Who grew up in the Depression, definitely lost some money during the Depression and became a very conservative investor who was interested in finding sound companies. Dougal's just is holding up the Intelligent Investor book, which is probably a number one recommendation of mine. It's certainly top 3. So that's by Benjamin Graham. Benjamin Graham ends up with a very successful and almost like Depression era, think of if you had conservative, frugal parents. It's kind of like that taken to investing. Really sound. A lot of people say if you're a value investor, it's just something you're born with, right? So Benjamin Graham ends up as a professor at Columbia Business School. Many of his students really take to his principles. His most famous student is Warren Buffett, but he has a host of other famous students. And there's a essay written by Buffett in 1984 called The Super Investors of Graham and Doddsville, which David Dodd is also considered a founding father of value investing, although he's not as popular as Benjamin Graham. Douglas, tell me if this is too much background.
There's no such thing as too much background.
All right. Yeah, for the history nut over there. Where Buffett lays out, he basically says in this essay, like, listen, I'm not a genius. Everyone following these principles, all these people that are super investors of Graham and Doddsville that are basically trained at Columbia Business School using a value investing methodology are outperforming the market significantly. What happens from that point forward is it's almost it's where the story gets interesting, right? When Buffett meets Munger, Charlie Munger is arguing that it's not simply about buying the cheapest companies based on fundamentals. Some people call those cigar butts. You're like, it's a cheap, sometimes dying company, but there's a last puff of smoke in there that you can take as your return. So Buffett starts to shift towards buying more expensive, but also companies that he thinks are significantly more valuable. And that's where the conversation about a business moat comes in and everything else. And so the Buffett folklore shifted from someone who was making 50% returns a year, like really unrealistic or almost unbelievable returns a year for the first 20 or 30 years of his career, with a strict deep value methodology, to someone who buys more like Coca-Cola and American Express and See's Candy and all these things that are certainly more expensive, but also Buffett would argue, and he's probably been proven right for a certain period of time, that there's a deep business moat there and that it can make more sense to pay up for value. So that's the backdrop that's happening in this book.
That was beautiful, man. Seriously. That was really beautiful. Billy Shakespeare wrote a whole bunch of sonnets. That was
Let me check
good.
my notes here, Dougals. That was all off the top of my head, right? So
love it. Love it.
Now this book says, like, which one of those is right and where do we go? And I've probably mentioned this on the pod before, but Buffett's style is fabulous if you're the Michael Jordan of investing. Like, when Buffett starts to deviate and say, oh, you need to find companies that have moats and are more quality, that's fabulous if you're one of the most gifted people in the world at finding that. Your average investor, or even your above average investor, is simply not. So that's where I say, listen.
Let me jump in for 1 second. You can keep going. Because that what you just said, thumbs up, get it. There's also a part of this of scalability that's important, because when Buffer meets Charlie Munger, who dropped that knowledge, which I think was good knowledge, also around the time where Buffett's hedge fund that he was running at the time, right, was starting to get to a point where it's hard to, I don't remember what size it was. I think they mentioned that in Acquires Multiple, but it was so big. You have to start getting into a point where you're buying like large percentages of companies, and it might not even be possible for you to cigar butt it.
Exactly. So that's another thing that I always mention when people talk about Buffett's current picks or Berkshire's current picks, is like, there's like 20 stocks in the world that are meaningful to them. You have to be a massive company because they have so much money. So that's another thing to think about. And I'm sure we'll discuss that more. As it relates to the book, a guy named Joel Greenblatt, who we've talked about before, liked a quantitative approach and said, I see merit to the deep value and I see merit to paying up for quality. And so he created this simple formula. He called it the magic formula. There's a whole book on this, quality read if you're into that sort of thing, where he takes one component on cheapness and one component on value. His component on value, I believe, is ROE, if I remember correctly. He meshes those together. He does like a force raking. He buys like either the lower third or the 30 cheapest stocks or whatever. He has a fund.
Yep.
Great performance over time, right? So then the Acquires Multiple does something very similar. It improves the approach to measure cheapness by kind of getting rid of some of the accounting shenanigans, looks at a true enterprise value, and then a Buffett metric called owner's earnings. I'm not going to go into the deep details there. If the listeners hit us up and want us to do a deep dive, we can. But basically, he refines a way to classify cheapness, and then he compares it to all these methodologies. So he kind of compares it to the Buffett methodology. He kind of compares it to the magic formula. And the backtesting shows, and the backtesting are from my real boys, Michael Steckler at Euclidean Technology. I got to give a shout out. And John there too. So celebrity sightings in the book, which I enjoyed. Obviously, because he wrote the book, the Acquires Multiple has the best performance. Douglas, let me just add one more thing, and then I promise to be quiet for a second here. Every time you read a book, every time you read a paper, every time you hear a podcast, you should ask yourself what the person is trying to sell, because that's kind of how life works in academic research or investing research, is like you're trying to sell something. So I think as you read the Acquires Multiple, you should have that in the back of your mind. But in its heart of hearts, the key takeaway here is deep value investing done well outperforms. And that's what I'm trying to articulate to you last week. But tell me your thoughts.
I have lots and lots of thoughts. I think the book, here's my perspective, my overall book review is, I think it told a whole bunch of good stories, and I like those stories. Yeah. Like I enjoy the historical perspective. I was showing you my copy of In Search of Excellence, which we'll get to in a second. And I pulled up Intelligent Investor. One of these has a slightly more worn cover than the other, right? I've dug through the Intelligent Investor much more than I read, something like In Search of Excellence. But because I think the concept, and I'm gonna drop Chamath here for a moment, which is gonna make you like feel all giddy inside.
No, let's go for it.
But I think the concept that if you buy something that is less valued today than you believe it will be valued in the future, I think that is the underlying principle of all investing. Now, the way that you approach that, like there's a difference when you get to actual value investing, which is what you're saying is like, how do you manage your downside? How do you have more margin of safety? That's different than betting on something that might even be perceived as expensive today, but you believe it will still be worth more in the future because you're betting on the upside versus managing the downside. I think that's different, but I still ascribe to that. So I think his stories were really interesting. I think the book was as you mentioned, simple read, had good stories in it. I think some of the simplicity didn't feel good. I don't know what to call it, right? Were places where it was almost like using simplicity to his advantage from a sales standpoint when it was convenient, and then like ignoring where the simplicity was kind of contradictory. Like I'll give you an example. If you look at and I know the In Search of Excellence stuff he used that as an example of a separate report, but you have to separate out management from like management excellence. So I'll say management like overperformance from investment overperformance. I think you have to separate those two things out. And he like combines them when it was convenient or not. Like there was this, I texted you this line that was near the beginning of it that just got me like all in from a simplicity standpoint, riled up. I'll even say riled, and coiled. He said, unprofitable companies tend to become more profitable. Okay, so that was just like, that was the line. There wasn't even context dropped around that. And like, if you want to look from from a business standpoint, from a management standpoint, if I look at my bottom line, my net profit and go, okay, I'm unprofitable, but I heard that tends to become more profitable. So let me just like go and hang out and wait for that to occur. Like, that's not the way that the world works. I think that you have to drop so much more context. I mean, generally,
do you want me to defend that lie? Your criticism is warranted.
Go for it.
This is what we've talked about this before. Like, if there's a company of 5,000 people and they're having tough years, basically those 5,000 people show up to work every day and go, listen, we lost 10% last year. Like, we can't do this anymore. And we're working through being more efficient in our manufacturing process. We're laying people off. We're doing all these things. And that's all. Where that neglects is that some companies are unprofitable until they run out of money, and then they don't exist. And I think you have to mention that caveat. But there are a lot of other companies that say, we're going to do better and we're going to work hard to get back to average. And that's what he's trying to articulate.
Yeah, but there's something really important. I get that. I think there's something that's really, really important in that. Even in your example, you said a company has 5,000 employees, ... Yeah, so if you have I would even, if you don't even want to go into more detail, but just throw a couple commas and semicolons into that sentence and say companies that have a generally strong foundation and are currently like unprofitable tend to become more profitable. Yes, I will then say,
you're making my point for me. That's my point 5 minutes from now. So I love this. We're on the same page.
And that's fine. But this is my point, where it was like, when it's convenient, you have simplicity, but you can't leave out like some of that nuance sometimes because it's so important. I'm going to drop into and hold me back if you want to tackle something else first, but I'm going to drop into the report that he mentions along those lines. Is that cool? Okay.
Yeah.
So there's this report by Barry Bannister, and it's called Revisiting In Search of Excellence, a Portfolio and Management Perspective. So apparently the brief background on this was there was a researcher back in the late 80s that looked at companies that were seen as successful from a management perspective. There's this book, In Search of Excellence, written by Tom Peters and Bob Waterman, McKinsey, boom, boom, boom. And so they were saying, they looked over, I think, like a 3-year period, and said, if you look at companies that follow their philosophy, or sorry, that had the numbers as Tom Peters was saying, if you look at that and then look at them over a 3-year period, it looks like the companies that actually are the opposite of those companies, so the unexcellent companies, would outperform.
Yeah.
And then Barry Bannister came in 1990 and said, that seems interesting from a 3-year perspective. Let's look at it from a longer term perspective, and looked at it for like 10 or 15 years, something like that.
Yeah. So the first paper is Michelle Clayman. Let's just
there you go.
Credit for good work. The second paper is Barry Bannister and Jesse Cantor.
In 1990.
Yeah.
Yeah. And so then 23 years later, in 2013, Barry Bannister and Jesse Cantor came back and updated that paper, so it has a multi-decade view, which I think is pretty cool. Like, and it's an interesting like paper generally to read. We had to find it in like a scanned PDF that someone probably did in the back of a CVS. But looking at it's pretty interesting. What I want to tackle here in this that's interesting, and this is different from what Tobias dove into in their book, was that he's looking at the S&P 500. And so to be in, and some of these numbers will change over time, but just to, what is the S&P 500, right? People broadly look at that as the market. It's roughly the top 500 by market cap stocks that are out there, but there are some other criteria. So you have to be, as of today, you have to be at least $11.8 billion, right, in market cap. That number changes over time. You have to be highly liquid. You have to have public float of at least 10% of your shares outstanding. Your recent quarter has to be profitable, and then your last 4 consecutive quarters have to be, in summation, profitable if you add them all up, right? So that gives a foundation of success. And so like if you're looking at companies within the S&P 500, even the bottom most company has done something pretty solid in its life so far to get to a place that's $11 billion.
Yeah, let me clarify one thing, because the statistics you gave on profitability, I think that's to initially enter, but they're not going to kick you out. Yeah.
Yeah, you're right. To be eligible. That's right. My broad point is like the S&P 500 isn't a random assortment of stocks. It's not like you're looking at the 7,000, equities that are traded today. You're looking at the top, right? The largest. So anyway, that aside, what they did in this report, I think, is pretty interesting. They said, if you take $1,000 every year, going back to 1972, the middle of 1972, and look at those companies that follow the formula that Tom Peters and Bob Waterman laid out, which are what they call the excellent companies, which includes a bunch of profitability measures. And you look at the top there, and then you also look at the top or the bottom companies that are like kind of the bottom of the dregs for those same, and look at those over the past 5 years.
Those metrics are important, so I want to mention them.
Yeah, drop knowledge.
The metrics used to determine excellent companies for the Tom Peters books are 5-year growth of total assets, 5-year growth of shareholder equity. It's all 5-year stuff. Average return on sales, average return on total capital, average return on total equity, and average year-end price to book.
Yep.
So
great.
The excellent ones would have so-called good metrics. The unexcellent ones are basically the bottom third of those metrics, so-called cheap metrics, I'd call them.
Yep. And so they looked at, I think they looked at each year for the previous 5 years before the $1,000 investment was made, and said, what are all the companies that fall into the top third, right, over those years, and what are all the companies that fall into the bottom third? And so they would put $1,000 in. So actually, let me back up for a moment. The unexcellent companies outperform the excellent companies, like hands down. Like that's like
consistent,
no matter what.
Bar none. Yeah.
The unexcellent companies.
The main takeaway I care about, but I want you to get to your other point.
But the second one, the one that's actually more interesting, is what they did relative to the market to me. Because the unexcellent to excellent piece, to me, I'm like, sure, like I can believe that. You're all in the S&P 500. And so you've all gotten to some level of excellence. And so I can believe that reversion to the mean within the S&P 500 is like a simpler cognitive element for me to get to. But beating the S&P 500 by this much is actually, it's like so significant that's what I like zoomed in on.
So I'm not as fired up about it. Here's my takeaway. My takeaway is this: no one in their right mind would ever take these unexcellent companies and call this their investment strategy. All they're trying to do here is take down the book. And what they did is they did that really successfully. The fact that these unexcellent companies outperform both the excellent companies and the S&P is incredible, because this is not a value screen they made to maximize investment returns. They bought some crap here simply because they were trying to buy the opposite of what the book recommended. They bought companies that were pretty much surefire to go bankrupt, and they kept those in the analysis and set that the value of that purchase to zero when that company went bankrupt. Like, it's incredible.
Yeah. So this is just going to be hot fire.
There you go.
So I'll say two things. One, it's very difficult for companies that are in the S&P 500 for you to say surefire to go bankrupt. Like, no, like that's an aggressive take. One.
Okay.
Two, I would say you can't take, this is mixing a management book with an investment like report or book, I also say is really difficult. And so it's hard to take down a management book by looking at an investment report?
So actually, let's still drill into that. I think what's happening here, I don't know if the book explicitly claimed that these companies were good investments, but I think it unintentionally implied that. That's what happens with a lot of these books, right? So they're going around after they study these 43 companies that are called excellent companies, and they take away the key characteristics. They're going around trying to teach other companies to be excellent. And then I think the human brain goes, oh, well, if these companies are so excellent, obviously their stock performance is going to be excellent. Their financial performance is going to continue to be excellent. That's where that doesn't prove to be true. There's rare exceptions. I'm not sure that they explicitly said these companies would be good investments, but I think the human brain jumps there. And I think it is important to say what's probably more critical is mean reversion rather than something continuing to shoot to the moon.
I hear that. And I think, what the book would say is that these companies had excellent performance. These companies were actually excellent performance in stocks too. Now, to your point of what you brought up at the beginning, someone's trying to sell something, right?
Yeah.
And part of what I'm trying to break down here is that what they were trying to sell is management consulting services, not investment consulting services. And the human brain can take things implicitly and run with it, and it will. But to say there was a writing about management consulting services, and I'm going to take that down by telling you about my investment consulting services, is you're using it for what you're trying to sell, and more power to you. I think it's hard for me to then like give that full credence.
But
I'm a purist.
That's fair, but
in these ways.
let's keep peeling that onion. So if it's 1985 and I really want my company's struggling and I really can't wait to hire Tom Peters so he can teach me about these excellent companies. I'm the CEO of a Fortune 300 firm. What do you think I want out of that? I want my financial performance to improve significantly to start to look like the financial performance of the 43 companies from his book. And what he's actually giving me are probably principles that allow him to collect a big check and don't directly tie to my company's financial performance. What probably is going to impact my company's financial performance is reversion to the mean. I'm probably going to move more towards average. And that's for some of the reasons we've discussed on the negative side. Go ahead.
Yeah. I think that's an argument in the opposite direction, because these so the excellent companies, if you look at their historical returns, right, they were above the unexcellent companies, which is, that gets to the reversion to the mean point. So if you're a company who has been struggling, then in theory, this does not occur necessarily in the real world all the time, but I'm saying in theory, if you do implement what the excellent companies did, then you actually then might revert to the mean in a more accelerated fashion. Maybe. I'm just saying, like, in general, that's the way you'd use it. But you certainly wouldn't say, let's look at what the unexcellent companies did and start replicating what they did in order for me to drive financial performance. That you certainly don't want to do. But it's all what you're trying to sell. I get that.
Whoa, certainly. Let's just chill on your certainly. Depends on what you want. No, depends on what you want. So your unexcellent company 3 years later is probably going to have significantly improve their financial position because they're desperate, they're losing money, they're working hard to fight back to average, right? So they might make decisions during that time, and it might be like really basic. You don't need McKinsey or BCG to be like, you lose money on this product, don't make that product anymore, or raise the price on that product. Or, this is basic, like, human grittiness to try and survive. So when you say you certainly don't want to do what the unexcellent companies are, it depends on what period you're looking at and how your profits evolve in the future. Like, you might want to make the cutthroat decisions that some of the unexcellent companies are forced to make to improve your profitability. And in some cases, even if you're the so-called excellent company at the top of your profit cycle, you might want to consider not sitting around and counting your profits, but working hard to try and predict the next challenge that's coming your way, or what your competitors are going to do to take you down.
Absolutely. I think it's a great point. I guess I was saying that the playbook that you want to create is probably not the playbook of the worst performing companies.
Agreed.
Now, there might be,
especially what the worst performing companies did 3 years back. Like what the unexcellent companies did 3 years ago is the wrong thing, because they're at the bottom of their profit cycle. They're losing money hand over fist. That's where you want to steer clear. But I think it's that future prediction tool. It's what the inputs to the model that led to the outputs 3 years later that gets lost in the shuffle here. And a lot of times we miss the target by focusing on the wrong time frame. It's funny that Douglas and I ended up debating. So if you haven't read the book, you might think this study that we just debated is like the core principle. It's probably like it's like mentioned.
It's like 2 pages.
I found it interesting. Yeah, it's like 3 pages total out of a couple hundred. So all in all, if you're interested in that stuff, it'd be a good read. This could be I'll be curious to the response about this one, because we haven't really gone deep in our book report section of the pod just yet, and we just did. And then on top of that, we layered some investing research that's like, 40 years old on top of that. This is really riveting listening, I'm sure.
Well, no, this is it's 8 years old.
Yeah,
I mean, if you go back to the original, but this is only 8. Yeah. Come on, baby.
Yeah, but all based on a book that's 40 years back. What's in the fishbowl for you?
So it's news first.
Let's do it.
Your boy, I'm not going to attach myself to him. Bernie Madoff, unfortunately, passed away this week, talking about value investing.
Wait, can I give you one good story about Bernie Madoff? I can't find the title of this book, but there's a book basically about how to avoid getting defrauded. It's written by a professor at the University of Colorado. He wrote this and did the big press tour and everything. 2 weeks after he released the book, the Madoff fraud was uncovered, and he had a third of his retirement with Madoff. So he wrote this
hold
book.
on.
Yeah. I'll put it on the Twitter at Skippy Douglas. I swear, this is just hilarious. And I haven't read the book. I just think that story it just cracks me up.
Yeah. You got to ask what people are trying to sell.
Yes, right?
Yeah. Oh man, that's crazy. Yeah, so he passed away for, I think everyone probably knows, but Madoff was the Ponzi scheme investment guy for 40 years, been in jail for a little bit, no longer with it.
65 billion that they think he effectively stole.
It's insane, man. I mean, that's just like, it's insane. It's insane.
It's sad. The one thing I'd add there, so Madoff's fraud, I'm not an expert on it, but one of the things he had to do with the Ponzi scheme is basically always have more cash coming in, right?
Yep, exactly.
And so when people talk about what should have been obvious about it in retrospect, one of the things is like the really consistent returns. I don't know the exact numbers, but it was like always like 8 to 11% every year. And so people would look at the historical performance and be like, that's what I want, because that's how the human psyche works. Like the price of admission to making great returns in the stock market is the turbulence, right? And so he took out that turbulence and made it really desirable. He basically fooled the human imagination to be like, this is a free lunch. And that's how he consistently found new investors. So if you're looking at investments like that, and it seems a little too good to be true, it probably is.
Yeah. Speaking of frauds and inflows, did you see what the SEC is starting to talk about SPACs?
Just briefly, yeah. But you called that weeks back, man.
Yeah, they're not. I mean, so they've only said some brief stuff, so it's not so there's not too much yet. But I do think it's pretty interesting. And as a recap for folks, so this year through, I think it was March, I think it was through the end of last month, there was about $100 billion that SPACs raised this year, which was more than they raised all of last year, which was more than they raised ever in the history of the universe. So there's a lot of money going into SPACs, and SPACs are companies that are basically given a blank check to go buy something, right? And the level of rigor and regulation that's in what they're buying has been a little bit, as Stephen Hawking once said, it's loosey goosey. So, but one of the
Stephen Hawking didn't say that.
Tell me, show me evidence that shows he
show
never
me
said
all his
loosey
quotes
goosey
ever. All right.
Yeah, exactly. But But so one of the ways that the SPACs go out is they issue warrants, right? So like the founders and whatnot get warrants, and these warrants they can be. And for those that don't know, so a warrant it's basically like a stock option. So you're saying that in the future you can pay a certain price, or you'll be paid out a certain price once the SPAC acquires whatever the company and they have the reverse merger. So these make a lot of people pretty rich. And so for example, it might be that you're the founder of the SPAC and you say, at some point in the future, I'm going to pay $2 a share, right, for this company. The SPAC goes out, buys another company. It shoots up to $100 a share. And now you've got $98, minus taxes and profit. And so the SEC issued something last week that said that basically they're going to look at these warrants, and they might have to treat them as equity, assets, or liabilities, depending on how they're structured, which changes a lot of the financials of how SPACs could work. So it won't impact every SPAC, but it's kind of saying at a high level that SPACs may not have the same regulatory advantage that they had historically. Can I drop one? You got something to say there? I want to drop one line, like a quote, because I think it's phenomenal. Okay. I'm going to say that this is an accident, right? And a typo, but it's the greatest typo of all time in my mind. And I also kind of want to say it's not a typo because it's so great. So I was reading a Wall Street Journal post about an article about this. And here's this quote. It says, a senior SEC official said last week that SPACs might not have any regulatory advantages over the standard public offering, signaling the agency would scrutinize the failings the same way they do IPOs. One letter. There was one letter difference in there, and it was supposed to be the filings, right? But I was like, that has to be purposeful, and also maybe it wasn't, but it was perfect.
It's great. Hey, you get in on that coin IPO? I'm sure you're in on that, right?
No, I didn't. It was fascinating though, right? I love that that tweet that you sent out about it.
Yeah. So let me pull up some details, because that actually it's worth discussing. I did a little poll on Twitter, because the valuation was supposed to start. They thought IPO price was around a market cap of around $60 billion, right? And it ended up after day one at about $85 billion, right? So
yep.
An exchange like the NASDAQ is valued at $25 billion. An exchange like the London Stock Exchange is valued at about $50 billion. Coinbase is valued at $85 billion. Now, let me try and give you both sides of this equation, right? So, one, crypto is more like worldwide. It's a asset class, if you want to call it that, that's early in their stage. So I think you could say, hey, who cares about the London Stock Exchange? Like, that's people in the UK and Europe, and this is like worldwide. But let's not pretend like Coinbase is the only crypto IPO out there. I know of 20 off the top of my head. Now, Coinbase is the most well-known and probably the most widely used within the US. But in China, no one cares about Coinbase. In Australia, no one cares about Coinbase. So if you want to say this is worldwide and that's why the value makes more sense, I don't know that that's actually true, because I think there will be exchanges based on locality, just like happens with stock exchanges throughout the world. So that's point for and against the valuation, right?
Yep.
The other point for and against the valuation is the fees are insane right now. Like, you can buy $10 of Ethereum, and on Coinbase they'll charge you $1 to do that. Like, that's really, really high. That's nowhere. I mean, NASDAQ, New York Stock Exchange, people would laugh if that was the charge. So you can say, well, it's way more profitable than those other exchanges, therefore it should be more valuable. Sure, but this is the mean reversion point we just talked about. Like, there's no way that level of fee remains. That floods competitors to the space. And as people get more knowledgeable about the space, they're also just going to refuse to pay that fee. It's too much.
Yeah. I'm curious if, I don't know what their, I said I was going to read the S1. I still haven't read it, but at some point I will. But I'm curious as to whether or not they talk about their longer term strategy. They probably don't in all that much detail.
Yeah.
But I would think, to your point, because I think that's exactly right, it would have to be from a fee perspective, something where they say, we have somewhat of it's not a monopoly, but we have first mover advantage in the US at least, right, around this. So we can charge heavier fees, and we're going to use that to land grab. And then we'll lower fees when other people like start to come into the market to lower fees, but we'll have all the supply, or demand, whichever side. I don't know how they're going to manage that. I wonder if they're looking at that, but you're right. I mean, that's insane. It's an insane price.
Well, and then when you value the company, I mean, their S1 said 98% of revenue is fees. So if there's not a moat around those fees, the company's worth a fraction of what it's. Well, and even the 60 billion valuation, I think, was insane. I was hoping to have some material to talk about on the pod, so I put in order at $100, knowing that it wouldn't get filled because it started at 250 and went like to 380. But I wanted to have one share just to gloat over you, Dougals, and I wasn't so lucky.
Oh, speaking of one share, how's your dog coin, bro? What's up with that this week?
My Dogecoin is all right. So I think I have 1,080 shares, risk free too. Again, for those who haven't been with the pod for a while, 10 episodes ago or so, me being a deep value guy, cryptocurrencies is like the antithesis of what I invest in, and I wanted to do some research on the bubble, so I bought some Dogecoin back way before it was cool Dougals. I bought $100. It went from 4 cents to 8 cents in an hour or two.
Crushing
I unloaded, got my $100 out, and now I'm sitting on 1,000 coins just because I think it's hilarious. Because I have a podcast that talks about investing.
And now where is it?
So what's going on with that, man? That is GameStop all over again. Like it's just this frenzy of hyenas bidding this thing up. It went all the way to 50 cents. Now I think it's back down. I mean, in the 30s maybe.
That's insane. So you're looking at an 8x return in 10 weeks.
When I looked yesterday,
extrapolate that.
Texting me. Yeah. So if I do 800% every week, Dougals, this is how long my stimulus check will be. My stimulus check will be worth $2 billion. I love TikTok investors. So no, how do I say something intelligent about this? I am so ready for the bubble to burst, man. U.S. stock market's cape just reached 37. You have things like Dogecoin going up 900% in a month. I mean, the euphoria out there is just insane, and I am so ready to sit back and cheer this thing all the way down. I don't care if it gets cut in half. I don't wish ill on anyone. I'm not saying that, but my investments are long-term, and that would do me real good. I just feel like every week we see more signs of the bubble, but there's no sign of it popping anytime soon.
No. And as we've even talked about before, and as you spit lyrics about all the time, reversion to the mean, it's going to happen. And so the farther we get away from the mean, the more pain it's going to cause people too. I mean, I'm from what you were saying too, right? I'm ready to get down to the dirty. Like I'm not scared to get into dirty. That's great. But like there are people that are going to be throwing money in at a time, like right now, at a time that's nonsense. And if this nonsense increases even to like another 20%, it's even more nonsense. Like people are going to get hurt.
Total nonsense. So let me give a couple PSAs, not to be like high and mighty, but just to make sure people keep their mind right. So first is, if you follow any of this crazy hysteria happening with Dogecoin or 1,000 other ones, if you're on social media and you see whatever coin is trending, understand what's going on there. So like yesterday, I was playing around with that, trying to send funny pictures to Dougals because there's all these funny memes and I just think it's hilarious. And you go into some of these and the tweet will say, hey, I'm giving away 400 Ether. All you have to do is send 1 ETH to this address. That's a freaking scam. People don't do that. That's a terrible idea. They're not sending you any coin back. That's one of the things that happens with cryptocurrencies. They ask you to send it their way. They're not sending you anything back. I've seen pictures where people modify Elon Musk's Twitter feed. So it says, I'm about to give away Dogecoin or Bitcoin, like, and it's between two real tweets, and then they create a fake website, and you go to that website, and it says like, I'm giving money to the people to buy Teslas, like, really well done, and all you have to do is send over a little Bitcoin. Like, don't fall for any of that stuff. On top of that, with cryptocurrencies, when something goes up 900% in a month or 200% in a day, like, it's natural for the human brain to be like, hey, I should check this out. I'm not telling you not to check it out, but please don't misinterpret me and Dougals as recommending that stuff. Like, it's not going to end well. And here's the question that I would ask yourself if you're fascinated with crypto right now. If you buy a company, regardless of what company it is, regardless of the valuation, if you buy Tesla, you have some idea of what you think Tesla might be worth. There's some way for you, each individual is going to come up with a different value, but there's some way for you to say this is worth X. And so when the price triples or when the price gets cut in half, you can go, this still makes sense to me, and I either want to hold or sell. In some cryptos, maybe in Bitcoin, if you argue that Bitcoin is digital gold, you can look at the market capitalization of gold. You can do some analysis to say it's actually worth this. And so you can have some idea of when you might want to buy and when you might want to sell. And a lot of this stuff, and I'll use Dogecoin as an example, like, there's literally not a logical way to assess the true value. It's basically what the hyenas want to pay for it. And so to me, that gets defined as speculation. And again, I'm not telling the listeners that they can't speculate, but you better understand what you're doing is more like sports gambling or speculation than it is investing. So if you honestly bought like Dogecoin as an investment, I'd ask at what price you think you're going to sell it, because I don't know how you ever know if there's a true value to it. So sorry to be on the soapbox, but I just think it's important to talk through some of those things as we kind of joke about some of this stuff, right?
Thanks for dropping knowledge, man. I think that's right. I have one more fishbowl item, at least on my side. Speaking of digital currencies.
Yeah.
China's starting to ramp up its efforts even more. And I don't know if you've read about that this week, but China since 2014 has been working on a digital currency, and for national digital currency. And about a year ago, April 2020, they started trials in a few cities in that digital currency. So they're giving it out for people to be able to buy their pizza. And then they've now expanded to additional provinces in China. And what Financial Times, Wall Street Journal, et cetera, what they're coming out and basically saying is like, this is something that, and this is not going to be news to the US government, but something the US government really should probably pay some attention to. Because the way China is doing this is not like the way that the blockchain-based cryptocurrencies are doing it. They're not doing it in an anonymous fashion. They're doing it by saying, like, this actually allows us to track the spending of our citizens in a much tighter way. Like, we'll get real-time information on spending. I'll pause there. Let you come in.
Oh, I mean, it's the typical playbook. Am I supposed to be surprised that the Chinese government, who one day is going to show up at my house and like put me in handcuffs, but wants to track their citizens? No, I'm not surprised by this.
Yeah, I think for like, we don't even, this is not time to talk about the political ramifications, I think, of all of it by any means. Where I think that it's not interesting, but like noteworthy, I think to keep tabs on, is that I don't think that folks actually realize how much, in a micro way, how much influence the dollar has and therefore the US has. I think it's in a macro way. I think people do. Like, I think people are like, yeah, the US, everyone uses US dollars. Everyone will accept US dollars. Like, I think you kind of get that. But the US dollar like dominates the globe, like at almost I think a 90% clip as far as throughput, like around the world. And that's significant. It allows us to throw our weight around a lot. Like, the US does a bunch of stuff. If we get upset at somebody, right, we can freeze your assets because we can freeze our own currency.
Yeah.
And that comes into play a heck of a lot. And where that there's the political side of that, but I think from like the investing side, it's actually pretty interesting because outflows or inflows from our own countries, like stock markets. I'm not talking about next month or next year or anything. I'm just saying, like, in general, I think it's something like keep in mind. The two other things I'll drop like real quick is one, this currency, because it's digital, like China's saying they're going to make it programmable, which is obviously right. It's code,
Yeah, of course.
right? But so you can, it's like little gift cards. Like you can basically say, like, if you want to stimulate the economy, I'm going to throw out $10 billion. And if you don't spend this in the next 30 days, like the $10 million doesn't exist. That's like interesting.
Right. Let me jump in. So first of all, the US needs to get on board, man. This is one of those things that you can fight it and lose the battle and watch it happen around you, or you can embrace it and become a world leader. And stuff like that is super fascinating, and it takes so-called money to an entirely different level, and the US better get on board quickly. They just better, or they're going to be in trouble, because this is also a space where there's tons of innovation happening, and every time the US has fought against that, it's ended poorly. So quiz time for you, right? If you're looking at world currencies, fiat money, and comparing where Bitcoin falls in that, what ranking would Bitcoin have as a world currency right now?
Is this number of holders, total amount held? What's the?
It's basically market cap.
Market cap. 5.
Not bad. 14. So, I mean, right below the Swiss franc. If you denominate all the world currencies in Bitcoin and then rank them, that's basically how you get this. Isn't that fascinating, though?
It is.
I mean, and to me, none of this is investment advice, but where Bitcoin starts to get really interesting is if you get a large world government, because a lot of world governments do hold gold as some reserve asset, to say, you know what? I think we're actually going to hold Bitcoin. That frenzy of financial money that could come into the digital asset system when a government or multiple governments take that is a fascinating thing to debate. And we can do that on another episode. I don't want to derail you here, but 14, that surprised me. I mean, I didn't think that technically you'd be the 14th largest country in terms of populating circulating
crazy.
supply.
Yeah, that's really crazy. The Winter Olympics, not as popular as the Summer Olympics, but the Winter Olympics are coming to Beijing next year.
Yes.
And the tie into that is I assume, depending on what's going on in the world at that time, that there are going to be a bunch of international people that are coming into China in about a year from now. And I don't know what they're going to be doing with this digital currency around there, but it's like there could be something playful, I think, around there, playfully dangerous. So just dropping that. The one thing I'll say is basically all the articles that I read about this were taking the Skippy view of like, we should pay attention to this thing. We should pay attention to this thing, except one. Can you guess what the one was?
No.
The South China Morning Post was like, they were like, nothing to see here. There's nothing to see here. They found like one quote from, I think, like the Bank of Japan, and it was like, nah, this won't be a thing. But it was just funny because I'm like, I read like the Financial Times, reading the New York Times, reading the Wall Street Journal, and I was like, oh, look at this headline. Nothing to see here. South China Morning Post.
Well, here's the other thing that, like, I just think the U.S. needs to get on board, and I'm not saying the U.S. needs to create a cryptocurrency dollar, but just have a regulatory friendly environment. The game-changing thing, like you're talking about, is basically the analytics you can do on the blockchain of real-time spending. And I personally don't care if there's identities tied to that or not. So, I mean, a lot of people like that you can basically own these digital currencies without identifying yourself in a way that's really hard to do in the US financial system otherwise. But I don't care if a name's tied to it or not. Just to have the analytics around that movement of money is really fascinating stuff. Yeah. And it opens up an entire new world of decentralized finance, which is fascinating.
It's insane. Absolutely insane. I agree. A country owning that is a beast, to say the least.
A beast, to say the least.